Okay, managing the cap limit. So because we want to make sure that we do all try and get as much into super over our working lifetimes, it's important that we take every opportunity to maximise those. So a few of the things that we can do is make sure that we might be able to salary sacrifice into super from if you're working. And particularly if you are over 50, take advantage of that 50,000 amount that we know you can do this year and next year. If you're approaching 65, particularly if you're sort of 61, 62 and getting towards that 65 age, if you're going to be putting in non-concessional contributions, it's really important that you time them correctly to get the most in the lead up to 65, and I'll take you through some case studies on that a little bit later. If you're over 65 and you satisfy a work test, and many people are still working part-time or working in some capacity after 65, particularly if you're in your own business or you're on a property, then you can still contribute as long as you're working more than 40 hours in any 30-day period during the year. Personal injury settlement proceeds, this is an interesting one. If you or anyone you know has got a personal injury settlement happening, if the settlement is as a result of you having been made totally and permanently disabled, the whole amount of the settlement is able to go into super and it won't be counted towards either of the cap limits. So it won't be counted as either a concessional or a non-concessional. So that's quite important to keep that one in mind. Small business capital gains tax concessions, that's almost a whole other session on itself. But I did just want to point out that if you're selling either your business or a property that has been used within your business, that it's important that you get advice from your accountants on how these small business concessions work, because they may be a way of also getting money into superannuation that's not counting towards the cap limits, and that is also going to reduce your capital gains tax significantly and to nil in some cases. So make sure you get advice before you do that. Spouse contributions, if you've got two, husband and wife, and one is working and one is not, the employed spouse is able to contribute on behalf of the non-employed spouse, so that's another way of getting some into super. Spouse contribution splitting, I originally had spouse splitting on this slide and my staff told me that wasn't appropriate. I had to say contribution splitting. With this though, when you make a contribution to super, you can choose to split up to 85% of the contribution across to your spouse. So you still get the tax deduction, or your employer gets the tax deduction on your behalf, but then you can split the contribution across to your wife or your spouse. So this might be important now if the government is going to change the rules to say that after 2012 you get to put the 50 in if you've got less than $500,000. If you're the one contributing to super and you're getting close to that $500,000 account balance, you may now want to consider splitting your contributions back to the other spouse to keep you both under the limits. So just something to think about. Gearing within super, I'm going to talk about that in a bit more detail, and leasing your own business property from your self-managed fund, that is a fantastic strategy. And maximising investment returns. Look, we're all constrained these days to how much we can get in, so it's important that the money in your super works hard for you to get the best result. So I just want to go through a few case studies now just to illustrate some different strategies, and all of these cases are ones that we've actually seen in our practice or advised on in our practice. So we've got Tom and Jane. They're both aged 40, they've got 3 children, married, and they own their own manufacturing business. They run that business through a company structure, and the company pays them salaries of $80,000 a year each, as well as contributing $25,000 a year for each of them into their superannuation fund. Now they're renting the business premises from a landlord for $34,800 a year plus GST plus outgoings, and they've currently got about $250,000 between the both of them in retail super, so your MLCs or your AMPs, and they own their own home and they've only got a small mortgage left. So they're like a lot of business people in that they're feeling a little bit frustrated because they're working long hours, they've got all the issues of having staff, the risk of having their own business, and they feel like they're maybe not getting ahead as quickly as they'd like to. Now that they've nearly got the mortgage on the home under control, they're really wanting to start thinking about potentially doing an investment property and seeing what they can do now to try and move on with accumulating their wealth. So I guess one of the first things to look at would be, could they actually go and borrow to purchase an investment property in a self-managed super fund? So Section 67 of the SIS Act says borrowing is prohibited inside a self-managed super fund, but then in 2007 it was amended now to give some specific exemptions to say that If it's a limited recourse borrowing, then you are allowed to borrow within super. Okay, and in the legislation it sets out very specifically what you have to do to tick all the boxes to get limited recourse borrowing. But a couple of the important things on this are that the borrowing has to be for the acquisition of a single acquirable asset. And there's a couple of important things with the words here. So acquirable asset just means it has to be an asset that is ordinarily allowed to be owned by a super fund. And single asset is one which I think is going to be a bit of a sleeper and may trick a lot of people up in that the tax office is taking a very narrow view of what single asset means. So if, for example, you wanted to buy a factory and the factory happens to be sitting across 2 title deeds, it's probably going to fail that test. So it really probably needs to be on a single deed, whatever the property is. So you need to be a little bit careful about that. And if you particularly wanted to purchase a property that might be on multiple deeds, I think it'd be really important that you try and get a ruling from the tax office before you proceed with the purchase. The other thing is that the asset has to be held on trust, and there's some brochures that we've got up on the back table that kind of set this out in a bit more detail, but you actually have to go and set up a holding trust within your super fund that holds that property on trust for the super fund, just for while the borrowing is in place. And the last one is that the rights of the lender are limited to that particular asset. So if it all goes pear-shaped in the super fund and the super fund can't afford to repay the loan to the bank, then the bank can only come and take that particular asset that the borrowing was used for. It can't go after any other assets within the super fund. So because of that, the bank's not going to want to risk their position, so they usually will only lend to 65% on these types of deals. And the other thing is they'll probably want you to give personal guarantees so that if the super fund can't pay it back, they'll come after you personally. Okay, so we can borrow in a self-managed super fund as long as we do it in a very particular way.